stream here.
Yeah, I would start the stream in a few minutes. Yeah.
So very cool. We are there. And Ron, glad to see you and congratulations again. That's so awesome. I'm so thrilled for your brother. And so let's just double check here. Excellent. And of course, because I'm using Zoom and I'm streaming, everything gets slower for me now. So it is what it is. Good. We're on LinkedIn, so we'll tap into that too. And good. All right. And we'll start in a couple of minutes. Let some people filter in here a little bit. Ah, there we go. Thank you. I'm going to copy and paste that so I can actually put it somewhere where I can read it.
No problem.
All right. Hey, John, glad to have you here.
You're on mute.
I'm off mute, I think.
There you are.
Hey,
I hear you.
how are you?
I am
Thanks, man.
good. I'm here. Glad to have you. I always like the interaction, people unmuting and, at least until the speaker starts. But I love seeing people. So.
Good. Same here.
All right. And hi, Alonzo. Glad you're there on YouTube. That's how I get his attention. Okay. And guys, don't be afraid to, unmute and show yourselves. You know what I mean. Okay. All right. It is now 10 o'clock according to my time on the computer here. So first of all, thank you all so much for being here. As you know, we try to bring up the things that we may not know about. We try to bring up the things that we need to learn more about. And why isn't my thing changing view? I don't know, but whatever. Okay. So again, I'm David Kinder. I'm the admin, and I'm really glad to have you all here. We're going to be learning today about what I called bank-funded lines of credit. Although everything I read from Greg here, it's all called insurance-backed lines of credit. We know what we're talking about. We're looking at bank funding of lines of credit backed by your insurance policies, your cash value policies. So let me introduce Greg. And we've been in touch, for the past, 15 months or so. And I just had it here. Here we go. So Greg Fatt is here with us today. After graduating from college, Greg joined a large investment firm in the Philadelphia area, where he worked with financial advisors to create strategies for clients, provided practice management advice to advisors who were looking to grow their businesses. His experience led him to join the institutional banking team at the BanCorp Incorporated, where he continues to work with advisors and insurance agents to help provide their clients with access to unique planning techniques and lending programs. His focus within institutional banking includes securities-backed lines of credit, what they call SBLOC, and insurance-backed lines of credit, IBLOC programs, and the advisor financing program in which he helps provide financing and other assistance to financial advisors looking to acquire or sell a book of business. We're going to cover a lot of different things. I'm looking forward to exploring the menu of services. And so, Greg, please unmute and take it away.
Very good. And I'll also mention I'm here joined by JT. John's been with the BanCorp a little bit longer than I have, and he'll be here to help assist if I miss anything or if there's any questions that he'll be able to add to. So I also wanted to introduce JP, who was able to join the call. Let me try to share my screen. I do have some slides prepared. Ron, thank you for the shout out, and glad to see you're already working with us and in the process of opening a securities back line of credit. So that's great. Thank you for the shout out. So yeah, we'll make this as interactive as possible. I'll try to, not slideshow you to death, but do think it'll help guide us through the conversation here with the insurance-backed lines of credit and some of the other services.
And real quick, Greg, do you want me to,
Yeah.
because I'm going to monitor the chat both in Zoom and in social media. Do you want me to interrupt you as they come in, or do you want to save it till the end? Your choice.
I think we can interrupt it as they come in.
Okay.
Yeah, we don't have too many people here in the chat, so yeah, feel free to stop me as those come in, or feel free to unmute yourselves. We're a small enough group. I think we'll be able to handle all that.
Very cool. All right, we'll do it that way.
All right, so just really quickly, just who we are, the BanCorp, in case you haven't heard of us. We're the number one largest prepaid card manager in the United States. So if you've ever bought a gift card or a prepaid Visa card, it's likely that we're one of the banks that back those deposits, and that really is what allows us to get into the lending spaces that we do. We do not do traditional lending like mortgages or something you might find at the bank down the street from you. We really are focused on helping financial advisors, financial planners, insurance representatives with more unique programs and products. And so that's really what we specialize on. We are kind of a fintech bank. We've been that before fintech banks were a thing. We don't have any regional branches, which allows us to be really lean and nimble. We're obviously very large, 7.8 billion in assets, publicly traded. Just to give you guys some background on who we are as the BanCorp. Okay. But what we're really here to talk about today is our insurance-backed lines of credit. So our insurance-backed lines of credit, we started a number of years ago, really to help clients and insurance reps get a better handle around insurance lending on cash value whole life policies. I'm really happy to say, and this is like kind of perfect timing right now, is that we're unveiling our UL and IUL products as well. So we're now able to lend against UL and IUL. We're kind of getting it up and running with a number of carriers. You'll see here, these are the carriers that we currently work with, but we're continually expanding this list. We have some kind of in our pipeline right now to be able to offer these services for more carriers as we evaluate them and get some more details on them. And I encourage all of you, if you all work with these carriers or with any others, feel free to reach out to us because we're really looking for insight from you all on which carriers to add to our platform. All right. As far as some of the nuts and bolts about the program for the insurance-backed lines of credit, again, like David, you mentioned, a lot of advisors don't even know that this kind of lending exists. There are definitely a number of benefits to using a bank like us to collateralize the lines of credit. I'll just go through some of the highlights here, and then we'll go into some of some of the differentiators and some of the other details. But really, the insurance-backed line of credit collateralizes 95% of the cash value of the whole life policy. There's some other calculations for UL and IUL. Minimum credit line that we need to at least approve clients for is $75,000, and that can be a combination of policies, which is one of the benefits of using this type of lending. You can combine husband, wife, multiple carriers, combine them all into one line of credit. We get to that $75,000 minimum that we need to approve the line, but there's no requirement to actually draw or utilize the line. So a lot of clients are setting these up for those kind of just in case purposes, or real estate deal comes up, something like that, or to refinance the current existing line of credit. We are Wall Street Journal Prime based, so that's the benchmark that we use. We do not use SOFR or LIBOR or any of those benchmarks. We think that there's a number of benefits to using Wall Street Journal Prime. It's a little bit more of a stable number, so it's a little bit more predictable as far as the interest rates go. And it is available for individuals, trusts, and the next slide is very similar, but it's also available on company-owned policies. Okay, that's a new benefit that we added about a year ago to allow you to collateralize the company-owned policies. There's no application fee, closing costs, anything like that. I usually say the only cost of the program is interest if there's an outstanding balance. Okay, so otherwise there's no costs or fees. And the interest payments, a little bit unique feature about our program is that when we built out the program, we really wanted clients to have that same kind of experience that they had when they were, borrowing from the carrier. A lot of clients don't pay interest, for example, on a monthly or quarterly or annual basis. Clients with carriers are typically allowed to just carry that interest over. So when we designed our program, we wanted the clients to have that same experience. Clients can capitalize their interest, so they can wait a certain number of time until the current balance cannot support any additional interest payments, at which point clients can either make an interest payment or we can increase the line if the cash value is increased. So that allows us then to to capitalize the interest and gives them the flexibility of when they want to make those interest payments. So and we make it really easy. Yeah, go ahead.
Is that like a calculation based on the projection of the policy and how much the loans are against it? They want to follow the same kind of rules as the insurance company, where we want to make sure that there's still a little bit of window room there before requiring a payment.
Yeah, so we can get right up to the approved line amount. Okay, so the 95% of the cash value in most cases. Otherwise, we use the maximum that the carrier will provide as far as a line. But we can get right up to that limit, and then once we're at that limit, then we would provide the increase. We would again review what's 95% of an increased cash value, be able to increase it, and then allow the interest capitalization to basically continue.
And they could defer making those interest payments for indefinitely as long as the policy will sustain it?
Yes. Yep. There's no required date. There's no maturity date. There's no, annual payment required. So as long as the available balance can support the additional interest payments, that can go basically indefinitely.
Okay. Very cool. So as long as the policy stays in force, of course. So.
Exactly. JP, I don't know if you have anything to add there.
Yeah, I mean, it's so I always advise clients to use a max of 94.5%, max of the 95%. So that gives them a 6-month cushion, because we allow 6 months of increases allowed twice a year on supporting documentation of cash value growth and dividend additions. So, if you did the policy loan today with us and it was on the books, in August, we can take updated status reports from the carrier that reflects the increased cash value and dividend additions and increase the line by 95%. So if it's a $10,000 increase in cash value, the line will go up by $9,500. So in reality, yes, it's an evergreen line of credit that has no maturity date end. But the increases will only go into effect if premium additions and dividends hit the account, right, on the cash side.
Right.
We see this a lot, 10 pay, 20 pay, type policies, which are popular, that have an end date to premiums. You're only looking at dividend additions and cash value growth of the cash portion of the carrier's growth on that bucket in returns. So, historically, when I'm talking to clients, Greg kind of mentioned it before, is there's a purpose as to why someone needs this line, right? Because that's asked on the application. 8 out of 10 of these purposes are for real estate transactions. It avoids other bank fees, other bank feed products, and it just keeps it easier for clients. Plus, they become cash buyers. Just wanted to add that little color to it.
Absolutely. I do have a comment or a question rather. Is it recognizing a PDA account soon, which is usually premium deposit funds? My initial thought would be no, because they're not officially part of the policy. But what do you say on that?
Unfortunately, at the moment, no. We've been having these conversations internally. I see JP smiling. We've been having these conversations internally. At the moment, the answer is no.
Okay. Yeah, because I see that as being external to the policy. It's obviously tied to the policy for funding purposes, but it's not officially part of the policy. Therefore, you can't really borrow against what isn't in the policy, which is my thought and explanation. Derek Morrell asked, if I have 6 policies that I own, can I add all the cash value together to get my total line of credit? And you answer that the answer is yes.
Yep, that's the beauty of it. As long as there's, we do have $5,000 minimum for the cash value in a policy. So if it's a policy for a kid that's $3,000 cash value, we can't add it until it hits that $5,000 mark.
Okay, perfect.
But yeah, husband, wife, multiple carriers. David, you were mentioning right at the top of the call, benefits if you're looking outside of just, interest rates, which we're extremely competitive on. We'll talk about those in a second. But, if we're looking outside of, interest rates alone, even if it's a, even interest rate conversation, the other benefits are, some of those things where we combine whole families' policies for one line of credit, get them into our, maximum break points by getting approved for the largest amount. And this way it simplifies the client's lives of one line of credit instead of, 6 separate small lines of credit. You know what I mean?
Yes, absolutely. So that's a huge value. Absolutely. Okay. Any other thoughts? But I did get a question on YouTube asking about financing for a line of for books of business. We'll get to that later when you hit that in your presentation.
Yeah, Ron had asked if so basically, yes, the policy has to be enforced for a year before it can be pledged.
Okay. Mm-hmm.
Yep, exactly. And I will also mention, I thought I was on this slide, but the typical uses that we see on the right side there, real estate is probably the majority of the uses. But we are getting a lot of right now tax payments, clients that might have sold businesses that, yep, I see Ron smiling down there. So clients that maybe sold businesses last year, had some capital gains come through, a number of different circumstances where clients are using these lines to pay the taxes for this year, and they just kick that can down the line. You get always, a lot of clients using these for tuition payments around, start of semesters. So we'll use these for tuition payments. Sometimes it's more favorable than, for example, student loan rates, right? So, these remain really popular options. Also, if you're talking to your clients about, maybe they're trying to leverage a HELOC or something like that, they got to go through a large underwriting process. There might be application fees, appraisal fees. These lines of credit, really the underwriting process is very simple. We'll talk about that in a second, but we're looking at credit score. These lines do not show up on a credit report once they're established, which is another nice benefit for our clients that we work with. And like I said, the application process is very easy and there's no application fees. So a lot of times, our advisors and reps that we work with are recommending these lines over something like a HELOC.
Perfect.
I'll skip forward. This is just a really similar slide, but just to highlight the fact that we do work on company-owned policies. All right, so you have those business owners that you're working with. The minimum here for company-owned policies is $200,000 instead of $75,000. So that's really the major difference. And just like the application for individuals and trusts, the only restriction to using these lines of credit is that you're not allowed to use them to purchase additional securities, right? This is not margin. It falls under kind of a different regulation. So as long as the client's not using this to purchase additional securities, all of those uses are eligible. A lot of businesses will use these to reinvest in their businesses, for example. All right. I know we've been getting through some questions here. If there's anything else, I'll talk about some of the benefits and differentiators here.
I had the policy should be done with BanCorp, and there's, I would think, yes. That's the only other question I got here. And
yeah.
Derek has this question. The question may be for offline, but my current bank line of credit against my cash value allows 100% loans to value. If you have over a 750 credit score, otherwise it's 95. They don't allow to capitalize interest though, so that perked my ears. Are there any exceptions to the 95%? So this is a BanCorp specific question, looks like.
So the reason, let me get into the reason why we have the 95% rule, or the max that the carrier will offer, is that if basically we never want to run into a situation where a client is stuck with our line of credit and something changes and they're stuck with an outstanding balance that they can't cover or can't collateralize. So really the reason we have a 95% or max credit line that the carrier will offer is to really protect the client and protect us and protect the representatives involved, because we never want to get into a situation where maybe you are leveraged up 100%. And I haven't, I'd be curious to hear that as offline, but if you're ever leveraged up 100% and something went wrong on the policy, or an event happened where we needed to close the line of credit or move the line of credit back to the carrier, in those situations, it's very easy for us to do that. We've done that in a number of circumstances where, the client wants to just move the line back, or something happened to the policy owner that we need to move the line back. And by allowing only 95% or max that the carrier will provide, it allows that process to happen. Otherwise, we'd be requiring a payment, could be a large payment of interest plus principal. And we don't really want to get into that situation. So I don't think we'd ever lend up to 100%. There are some situations where we might pay off an existing line of credit or work with the client to pay off an existing line of credit. But we typically stick to the 95% or the max line that the carriers provide.
And it's very
I'll
important
just-
that we understand the phantom income, because if a policy ends up canceling with a large outstanding loan, that becomes taxable income in that year for everything above the basis, and that could be a huge tax bill. So
Exactly.
we want to be very responsible with our clients in setting proper expectations, because this is only fantastic as long as the policy stays in force. Once the loan exceeds the cash values, I mean, I think it's, and I don't know how BanCorp or any other bank will determine that, but I'm sure you have to some monitoring process of some way. But you don't want to have that happen, because that has to happen in that year, and you don't want that tax bill to be on there. And if you didn't set up that expectation, that's going to be a problem.
Yeah, so the core states was mentioned on this conversation. Let them lend 100%, more power to them. But when they're having conversations with the IRS and the policyholder, when they have to satisfy a tax situation, as David just mentioned, we're not in that game to be a middleman to the IRS and the policyholder. And just to give you a little background on the firm, we've been in the securities-based lending business for over 20 years. Our lending rates against the collateral of securities are very conservative. And the reason why we do that is because we don't want to put a sell position on anybody that creates a taxable event in their accounts on appreciated assets to make up the difference on the loan to values against securities. We have, in 20 years of business, we have yet to close out anybody and create a taxable event for them, knock on wood. So we err on the side of conservative, and we think matching a policy loan that the carrier will do and 95% or 95% of cash value gives enough cushion to satisfy any tax liabilities and any closeout situations that might happen. So we are a very conservative lender from that standpoint.
Perfect. And I appreciate hearing that.
Yeah, we definitely want to protect everyone involved. So, just some of the differentiators, and I just have a few more slides here. Differentiators, our application process, I'd say, is definitely a differentiator of our program. Our platform is called Taleo. That's what we use for our securities-backed lending. It's what we use for our insurance-backed lending. It's a DocuSign process. Usually, either the reps at BanCorp can reach out to your clients with a referral, or you can provide the link for our online application to clients. But it allows clients to fill out an application really, really simply. It's really basic information. We don't require any income statements, tax verification, anything like that. It's really just a credit score run in the background during the application process. Application probably takes under 10 minutes to complete. And again, it's very simple information that clients mostly will know just off the top of their heads. Okay. We do require status pages for the insurance policy, so that's something you all can provide, or the agents involved can provide. That just verifies all the information including that we do not lend against MEC policies. So that's one of the reasons that we collect those status pages. Again, we don't want to run into tax situations with MEC policies, so either clean them up or or we won't lend against those. But if clients have multiple policies, we'll lend against the ones that are not MEC. Once we become part of the policy, we become an assignee on the policy, so we can't really make any drastic changes on the accounts. It's not like we become the beneficiary. I know there's a lot of questions on how do we become involved. We just become an assignee, so basically any changes that happen to the policy get run by us, and that's for obvious purposes, in case there's the policy is canceled or the client passed away, those kind of things. That allows the insurance carriers to notify us of those changes and make the corrective actions there. So the application process is very easy. Increases, I know if you guys are currently using other banks, some of the increase processes out there are pretty tricky and complicated. With us, we just need an email from a client requesting an increase and then updated status pages in the policies. It takes a few days, and then we approve the increases. We don't do additional underwriting. We don't need a new application. We don't need signatures on that. It's mostly an internal process that we can do twice a year. So once every 6 months, basically, clients can increase their lines of credit. And last point here on the slide about some of the differentiators. We do offer free checkbooks. So if clients want to, for example, use their lines to pay a contractor working on their house, they can pay them with a check. It'll draw directly from the line of credit. We have online banking services. So just like you'd expect from any other bank, they can go in there, ACH fund and so forth. Same day wire transfers. We do allow DocuSign wires. So a client wants to DocuSign wire themselves, funds from their line of credit, they can do that, or whatever other institutions accept wires. And we can send those wires within 1 day of the IBLOC opening, so funds are available almost immediately. Okay. Just some of the differentiators. I think we've reviewed some of them at this point, but we offer a fixed rate option as opposed to just a variable rate option. That was really attractive about 6 months ago. Obviously, clients that kind of saw writing on the wall locked in really favorable rates. Less so now, but there are still certain circumstances where that might make sense with our fixed rate options, and as rates change throughout the year, might make more sense. We do have
just to ask real quick, can they switch from variable to a fixed rate at any time?
Yeah, that's one of the beauties of our program. And we did have a lot of clients doing that. So clients can flip from the variable to the fixed. There's no fee to do so. And that's, in fact, what many clients do is open a variable rate line. And, 6 months ago, we're flipping to the fixed. There is a fee to go from fixed to variable. Okay. It's basically to prevent clients from flipping back and forth too often, or every month or something like that. But usually that fee is worthwhile if the writing is on the wall for interest rate changes. It would make it, beneficial to make that change even with the fee if you're going from fixed to variable.
So that's a big advantage over some of the insurance companies, because once you pick an interest rate mode, for lack of a better term, you're stuck with that until you repay it, and then you can take it out again with a different interest rate. Depends on the company, of course, but that's a big deal to know that flexibility is there.
Exactly. Of course, fast application process, easy line increases. We talked about that. Free wires, also available via DocuSign, interest capitalization. Our applications for trusts are extremely easy. We will need trust docs and a specific trust letter that we prepare that for the client to sign. But we don't need an opinion letter. We usually don't need lawyers to get involved with trust applications like we've heard from some of our competitors. And of course, we have our agent portal, which I think I have a slide on coming up here, so that you can monitor all of your lines of credit. If you're the agent, monitor all of your clients' lines of credit in one centralized portal, which is kind of nice. That's what this is, Total Cash Manager. So if you have multiple clients that are opening lines of credit with us, with BanCorp, whether it's our securities-backed lending or insurance-backed lines of credit, you will be able to monitor and view kind of balance those transactions and sort of that standard stuff through our advisor website, which we call Total Cash Manager. Usually after you get 1 or 2 lines with us, that's usually when I recommend reps signing up for this program. And there's a number of features in there, but this is one of the biggest highlights we get and reviews that we get from reps that we work with, is that you can monitor everything in one place. Makes it very simple. If you're having an annual review, or you're going to be running into that client, at some event, take a quick peek, look at what's going on in their accounts.
Hi, Professor.
Kind of wrap up here, but this is just a kind of a simple case study where Jack and Jane have a total of 6 policies. If someone had a question already about 6 policies, you might have with Northwestern Mutual and with M&M Bank, for example. Well, our program will allow you basically to combine all of those instead of having different banks, different carriers, different lenders. You'd be able to combine all of those. You get 95% cash value. We become a assignee on the policy. We get to the maximum rate discounts because you're combining all of them, and basically gives you a little bit of additional flexibility for managing all of the client's assets and all of the client's lines in one place. Okay, I'll jump through our rates really quickly. These are posted anywhere you need them, but our rates are extremely competitive out there. You see on the left side and the right side, we have variable and fixed rates kind of broken down there. Our rates are based on the commitment amounts, the amount that the clients are approved for, not actually borrowing, which is a little bit of a benefit. So if they get approved for a $250,000 line, but only use 10,000 of it, they get the benefit of the $250,000, rate discounts, the break points there. Same thing with the fixed rates. Our rates are based on Wall Street Journal Prime. Like I said, Prime is at 7.75 today. And so, we're looking at each policy kind of individually to find out where it makes sense for our client to go, as far as the interest rates are. This is for our whole life. We do have separate rates for our corporate-owned policies. They're slightly different. And again, the different minimums. And then our IUL and UL policy rates are listed here. Again, what I'd recommend, especially if you're just getting started or just want us to kind of do a quick high level, is send us, a few status pages that allow us to review what the cash value is, how much we would approve clients for, and take a look at what their current rates are. Because in addition to just the current interest rates, we're also looking at, whether the policy dividends are affected by having a loan out against the policy. And that's one of the reasons clients and advisors like to use a third-party bank like ours, because it just cleans up policies. For the policies themselves, they'll look like they have no loans against them, just have an assignee on them. So that's another little benefit for the advisors and clients. Those are all the slides I had prepared. I did want to make sure we focused on the insurance-backed lines of credit. I'll quickly mention, though, we do offer securities-backed lending and our advisor financing program. So if you work with a custodian like Schwab or TD, and you manage clients' assets, or work with third-party asset managers that are out there, it's likely that we'll be able to lend against securities. So we do lend against securities that are in managed accounts, whether they're individual stocks and bonds, or if there's mutual funds, ETFs, and so forth. So we're happy to take a look at those with you. And I'd recommend reaching out kind of on an individual basis based on where you custody. And we also do provide a advisor financing program. So if you have any, maybe you're looking to buy a book of business or something like that with the recurring revenue, because we specialize with working with financial advisors, we basically thought we have a great model for this. We rolled this program out a number of years ago. So we compete with other large banks out there, but we feel like we have a really good understanding of the revenue model and business structure for financial advisors. So that allows us to create pretty unique specialized deals for you. So if you are looking to purchase or sell your practice, we're interested in knowing about those, because we do offer that service for advisory financing. All right, I'll kind of leave it there. Kind of like around the half-hour point. So I just wanted to open it up. And JP, if I missed anything, any other
just
points, just let me know.
One thing, great job, Greg. The one thing I'd like to mention is that we did a little bit of a case study, but I'll give you real life examples of borrowers. I somehow got attracted to lending to a lot of business owners with individual policies and trust policies. A lot of the individual owners happen to be hedge fund owners. And these guys had some pretty significant policies where they were using that personal liquidity to fund and recapitalize their positions in their funds. And when you have that directly on a policy loan, it kind of prohibits you from going to your tax advisor and saying, "Here's the interest I paid. By the way, this money went towards supporting my business." Where at the BanCorp, we don't provide year-end interest payments, but at your last statement will show the total accrued interest for the year. So it gives your accountant the ability to maybe use that as a deduction. So really what your true cost of borrowing is whatever the deductibility is, if you have that capability to deduct that interest expense. I'm not giving out any tax advice, but I could tell you that on the real estate side and on the gifting side, if you want to stay in control of assets and you want to retitle, properties that you own or investment properties or gifting strategies and wedding gifts, and you're buying a house, lucky enough for your kid that just got married, you might want to stay in control of that asset and title it appropriately and work with your accountant to see if you have deductions. I'm just throwing out strategies for you guys that are producers that just throw some ideas into when you're having conversation with clients as to, create a case scenario for them to where it's an advantage for them. I thought I'd just share that with the team on the call here. That's pretty much all I got. I mean, the only other thing is that you do have the capabilities to combine both the UL and whole life into one line. Which is kind of nice that you have one line of credit, and it also helps with hitting the hurdles on the commitment amounts for the pricing of the loans. Just so you know.
Perfect. But and I'm sure each practice will be different. Did you talk about the multiple for practice acquisitions, or is those just underwritten in an individual basis? Is there any particular guideline on that? I had a question about that on there.
Yeah, so I think our minimum is $500,000 financing. Each deal is going to be looked at differently. We have a team that works with us to do the underwriting, to kind of look at the revenue model and so forth. So my best advice there is just reach out to us. We'll get a meeting set up to look at your individual circumstance.
All right. Perfect.
Yeah, on the price. So just to get back, I think the pricing valuation was part of that question too. Every practice is valued differently. There's a cultural aspect to transitions of business from ownership purposes and revenue stream makeups that create different valuations. I could tell you recently, within the last 6 months, as valuations have stabilized. They were a little out of whack about a year ago. There was insane multiples on sales of business. And that's because there was not that many sellers and more buyers than sellers, right? It's a scale of economics and supply and demand. And now with the turmoil that what's going through COVID and all that other stuff, there seems to be more sellers in the marketplace, which has stabilized the pricing and valuations in the space.
Okay. Yeah, you got both of those.
Quick
factors.
question. I'm sorry.
Go ahead, Alonzo.
So quick question, gentlemen. I have a snowbird who may be interested in releasing his book or his brokerage. Currently, I believe he partners with Cetera. And they have many of the carriers that you guys partner with already. So in terms of the valuation, do you guys do a valuation like pre-loan, or should we have the potential seller kind of give us their already created valuation?
So we do have so there's a dual underwriting process in our program. We partner with Skyview Partners as the first line of underwriting. and they have they do have a practice valuation service that would be required for the seller to provide them their revenue makeup. So they can go through the process, and they can also help pair off buyers if someone's interested. So I don't know what the cost is involved, but it would be all included in finding a buyer. It's kind of like an investment banking transaction, or solution for the seller.
Thank you.
All right, Ron, let's get to your question. How would the combination of whole life / IUL work into one line? Looked like the rates were different.
So the rates would fall into the IUL/UL pricing. So if you wanted to combine those policies all together, it would fall into that pricing. The benefit is that you'd be able to qualify for a larger amount by combining all those policies. So you'd qualify for probably more breakpoints, hopefully, by using the IUL/UL pricing and the whole life policies all together. But it would fall into the IUL/UL pricing.
You could do two separate ones, couldn't you?
If it made sense. That's kind of where we get into the situation of, let's see everything we're working with. Let's take a look over it. Let's see what makes sense for the client here.
I mean, other than monitoring two different lines of credit with two different policies, it's otherwise, if it makes more sense, especially if the whole life happens to be a bigger policy. But
exactly,
you got to build in the risk factor.
Points. Yeah, exactly. It'll depend on the break points and the size of the lines and how we combine them. Because sometimes we'll get into a situation, for example, where maybe the whole life policy alone won't qualify, where we may need to use the IUL and combine it with the whole life. So, it comes down to really an individual basis to see what makes most sense.
Okay.
Another quick question. If a client is interested in the loan, I may have missed this, but during the underwriting process for the loan, are you guys looking for, does there need to be a specific purpose for them to take out the loan, or can they use the funds for anything?
Can use the funds for anything, and our application is actually a checkbox that just says general liquidity. The only restriction being that you cannot use it for purchasing additional securities. So you can't go out and buy your favorite stock, for example. But if they, maybe don't even know what the purpose that they're going to use it for today is, that's why we have that general liquidity option. Maybe they're going to send their kids to school in a few years. Maybe they want to keep it open for that, or, buy that dream beach house, a year down the line. So there does not need to be a specific purpose. Yeah, there does not need to be a specific purpose known at the time of the application.
All right, cool. So there's definitely no backdoor margin accounts.
Correct. Yeah, it's definitely not margin. That's exactly right.
Thank you.
All right. Any other questions from anybody? By the way, I didn't see retirement cash flow as an option on there, but that's just for essentially that's an extension of general liquidity use and just measuring it out over time.
We'll have clients, I'm sure, similar to the way they're using the loans from the carrier. But we'll have a lot of clients that are, maybe retiring or have a few more years of income where it's going to make sense to draw from the line of credit. As we know, drawing from the line of credit is not a taxable event. So there might be a circumstance from a tax planning standpoint, again, not giving tax advice here, but there might be an aspect where it might make sense to draw from the line of credit as opposed to, maybe a traditional retirement account, right? Where, it's not going to count as income. So there are a number of circumstances like that when you're planning for clients, in those early retirement years, maybe when they're changing, what their income structure looks like, that this could be a useful option where they don't want to realize a whole lot of income they can draw from the line of credit. And we have a lot of different case studies. We have blog articles. We have a lot of different examples of how clients have used these lines. So I encourage you to check some of that stuff out. And before I forget, I will. You have my contact info on the screen here, obviously, for everyone to quickly jot down and reach out. But we'll also make sure to post, the link to our website. So if you do want to share that information with clients, we do have a quick YouTube video out there if clients just want to understand our program a little bit more. It's like a 2-minute YouTube video that helps explain benefits of this program. We can also share a link to our online application. So if you want to share that with your clients, if you yourselves want to apply first, that's how we get a lot of these started, as the agents want to check it out themselves first, practice what you preach. So we'll be sure to share all of those things with all of you.
Perfect. Go ahead, Alonzo.
One more quick question, and I'm sorry if it's a redundant one. I may have missed it. Are there minimums and or maximums in terms of face amount and loan amount?
Yeah, so the policies have to be open for at least 1 year. So we do have the 1-year seasoning process. After that, as long as the cash value is above $5,000, we will be able to add it to the policy, and the total line has to be approved for at least $75,000. So you might have two $50,000 policies that we can add together that'll qualify. You might have two $50,000 and a $5,000 policy that'll qualify. So the $5,000 minimum in cash value, and then the $75,000 overall total. But again, that $75,000 can come from a combination of policies.
Thank you.
Perfect. And for anybody that was on the calls I did last January, and I don't mean last month, but last year, when we had Tom Love and John Ouija, we were talking about infinite banking and all this stuff. We talked about bank issued lines of credit backed by life insurance policies, saying that they're better for the companies, because then the company keeps their assets in their general investment account as opposed to lending them. So the insurance company should love this too, as long as they're prudently managing and all that other stuff, and pricing their own loans. So who knows? So I wanted to make sure I threw that out there. So if anybody wants to go back on my YouTube channel, I've got a half-hour segment just with them talking about these kinds of concerns. So if you wanted to go through that, I want to get to Derek's question. He says, "What's today's variable rate for whole life on a $250,000 block?"
So if we go back here, 250,000 prime minus 1 is going to be 6.75%.
Okay. All right, and Ron, let's go through yours here, brother. His insurance back line of credit is at 7.25 now. The insurance company is 5.7. I love the ability to aggregate my family's policies, but there's becoming quite a spread here. What would be the disadvantages, if any, of moving my policies back to the insurance company in the current interest rate environment?
Well, I mean, one of the disadvantages, if you have a direct recognition policy, where, you're when you go back to a policy loan, it impacts the dividend paid on the policy with direct recognition. The other thing is, if you're using this interest as a deductible expense for tax purposes, it's more difficult to report that on a policy loan than it is through a bank loan. Those are some of the benefits. Believe it or not, I just had a conversation with a hedge fund guy this morning who is keeping the line open with us, and he has a substantial loan balance with us. It's really high loan balance, and he does use this as deductions. And when you factor what his cost of borrowing is after deductions, it drives the rate down significantly. So going back to mass at 5%, which he can locked in for a year, it makes sense to keep his line open with us at 6.25 because of the deduction capabilities. So everyone is different. Everyone's in a different financial situation. Everyone's in a different, structure financially. So it really is, work that through and have conversations with your trusted advisors to figure out what's best for you in that scenario.
Perfect. Yeah. Although not impossible to deduct interest from your insurance company issued line of credit, but it's a little bit harder to explain. Not impossible. It's just harder to explain. Why am I trying to deduct an insurance premium payment? So you got to make sure you've got your good paper trail on that. Absolutely. So
Yeah.
It's just easier. I like easier, but that doesn't mean it's impossible the other way. So. Better have good paperwork. Exactly. Okay. Any other questions? Let's get them out here. And unmute if you want. I don't have to do all the talking, I promise. Okay.
Hey guys, this is Derek. So I'm definitely interested. Is this something I just email you, Greg, and we can jump on? I can tell you what I currently have. I do have a line of credit with another bank, but there's definitely benefits with you guys. I like the pushing the interest off and all that kind of stuff. So I'm definitely interested in seeing what my picture is.
Yeah, capitalizing interest are zero wires. Those are just two simple ones. Where you're not going to get nickel and dimed every time you send a wire. To be honest, those little things sometimes are enough to help clients make the decision to come to us. So yeah, easiest thing. Like I said, feel free to shoot me an email. That's probably the easiest first step. We'll make sure that it makes sense for you and anyone else that's interested. But again, we'll post a link to our application if you just want to move ahead and go for it. We'll make sure to post that, and we can also feel free to email me.
Can you also post the link for the YouTube video?
Yes, absolutely.
Hey, David, I just want to get back to something you said about the insurance companies, not frowning on using outside banks for loans. It's important. I mean, one thing I'd like to share with everyone on the call, if they didn't know, that Northwestern Mutual actually has somewhat of a dedicated bank. It's associated with lending against their insurance products and also their securities products. And it's kind of like a white labeled piece where, and the reason being is because the producers at Northwestern Mutual, when there's a policy loan taken directly from the policy, it gives them a haircut to compensation.
That's right.
So I just wanted to share that with everybody, that we're not competing against the insurance company to provide these loans or pay off loans that exist with the carrier.
Perfect. And especially for anybody with Northwestern Mutual, now you've got a real big reason to use someone like BanCorp to make sure that your clients can actually use the policies while they're alive, and you don't have to get the haircut on it. But by the way, just to ask, I mean, obviously this is a great service that we need to provide as agents and advisors. Is there any kind of compensation to the agent for recommending? Is there any commission structure on there? I have no idea. I'm just asking.
That's a good question. We're not ADP. We're not a payroll provider. I mean, we deal with probably 4,000 agents throughout the country, and we just don't have a payroll system in place to pay 4,000 people. And
Okay.
That's just on the insurance side. Forget about the security side.
Sure.
So the way the security side usually works, just so everyone understands, is that there might be a revenue arrangement paid back to the investment companies, the broker dealers, or the wirehouses, and they could build that into the compensation model of the individual on how they compensate them.
Okay.
So that's another way to look at it, but insurance is different.
Yeah.
They're
absolutely. But it's a good question to ask, because I'm always curious, if we can enhance our revenues and such for making it, but that's all right.
The other aspect is then it gets into a whole legal review of, rewriting ADVs to show how you're compensated and all that. So it keeps it nice clean line that you're recommending this because it is the best solution for the client, not because there's some kind of financial incentive. So
and the people with ADVs, normally they have problems with that because now it's a commission. So yeah. And by the way, one reason to support BanCorp is I've seen them in almost all the NAFA events that I go to. And if we want to support NAFA, we want to support our sponsors. So I want to throw that plug out there, because if they support our trade organizations, we need to support those that support our trade organizations, so they keep us protected. So I wanted to make sure
we've become more and more involved with NAFA, and we're attending a lot of their events and helping sponsoring a lot of the local events. So if anyone's a regional president or state president or treasurer or anything like that, do feel free to reach out to us, because we love being involved in those events. We think that they're really productive for us.
Wonderful. Absolutely. And that's what sparked it back up, because I saw your guys over in Pasadena back in October. And so that's like, don't I know somebody with them? And that reminded me of you. So that's why we're here again today. So
another quick question, actually. I noticed you guys mentioned that we couldn't do, backdoor margin accounts, so we can't purchase more securities with the loans. Is there any rule against purchasing more insurance, like a single premium with the loan?
No, I'll answer that. I mean, the only thing I think you'd be prohibited to do is buy another whole life policy. I mean, you can go out and buy, a single premium. If you're talking about a SPIA.
No, I was actually talking about a single premium life, but a SPIA would be cool too, yeah. But they'd have to be, the right age and everything.
Right. I mean, on the single premium, I'm not a complete insurance expert, but it isn't a single premium automatically a mech.
Yeah, if it's a single premium life policy, yeah, that would be a mech.
Yeah.
So I don't know. You'd have to do a lot more analysis to make sure that really is the best fit for the client. I'm not sure I'd want to borrow money to buy another policy. Although,
Right.
that could be a premium finance kind of a thing. Depends what you're looking to do. I'm not sure I want to borrow money to fund a SPIA either. I don't know. That's kind of a gray area to me. I mean, and the carrier is going to ask, what's the source of funds for this? And once they say it's borrowed, you'd better have a really good agent cover letter to go with that. So obviously, Alonzo, I know who you are. You're going to do what's right for the client. The question is does it make sense? So.
Thanks for that. Yeah, I'm looking at multiple angles to kind of help out some clients who are in some situations.
Yeah, absolutely. No, I got you. So, but yeah, don't forget, we got to justify it to the company too. And so they'll take a little bit more calculations, I think, to make sure that really makes sense. Initially, my first thought would be it doesn't, but that doesn't mean that's right. So just my thoughts. I'm always careful about borrowing to fund policies. So it's just got to make sure we're looking at everything right, especially when the interest rates change. So, all right. And by the way, great question, though, Alonzo. Appreciate that. Any other questions? Unmute, show yourselves. We're not in the witness protection program here. Nobody's sparking up. But anyway, gentlemen, thank you so much. I think this was a great overview, not just of bank issued lines of credit, but on your stuff specifically. And so I think you're going to get a lot of inquiries. I had your stuff on the screen. Everybody can go back on there. I keep going back and forth between our Hollywood squares versus your contact info. So believe me, you could go back on the YouTube video and watch it, and you'll get his contact info. And I'll have it in video descriptions and comments and stuff like that there. So gentlemen, thank you so much. This was very informative, very helpful. And I did put the really long link. I don't think anybody copied it down, but we'll make sure we have clickable links that are easy to reference so they can get in touch with you, get in touch with BanCorp, and go from there. So, I really appreciate it. And anybody has any other questions? I mean, Greg is in our insurance groups, and so you can definitely ask him. Reach out to him.
I try my best to keep up with you guys, but you guys are running a million miles a minute. So I do appreciate that. I try to keep up as much as I can.
Yeah, well, we try to contain it a little bit too, so where possible. So, all right, everybody, thank you so much, and we'll see you back in the groups. All right, catch you at the next one.
Thank you.
Thanks, guys.
Thanks, guys.